The differences between ITOT and VTI lie in their underlying indices. ITOT is passively managed to replicate the performance of the S&P Composite 1500 index, whereas VTI is managed according to the performance of the CRSP US Total Market Index. As a result, ITOT and VTI are indirectly managed to replicate the performances of these respective indices. In terms of performance, VTI slightly outperforms ITOT in the short term, with a maximum return rate of 5.91%, compared to ITOT's 5.88%. However, ITOT's returns outperform VTI's over longer timeframes, with average annualized returns of 12.11% and 11.93%, respectively, over the past decade, giving ITOT a 0.18% margin. This suggests that the two funds are evenly matched, with each outperforming the other in different timeframes. When assessing investment risks using volatility and drawdowns, ITOT presents fewer risks than VTI. On the other hand, their Sharpe ratios indicate slightly lower risks for VTI compared to ITOT, although the difference is small. Consequently, ITOT and VTI are again evenly matched in terms of investment risk, depending on the metric used. Despite their differences, ITOT and VTI share more similarities. Both funds have an expense ratio of 0.03%, meaning they charge investors the same amount for equal stock shares. The narrow margin between their performances also suggests that they are subject to identical stock price shifts due to market forces. Ultimately, the choice between ITOT and VTI depends on the investor's preference for the underlying index, as the indices expose their replicating funds to the stock market differently. It can be argued that investing in one is similar to investing in the other, given their almost identical provisions and slight margins. Both funds are equally convenient, and the decision to choose one over the other will depend on individual investor preferences. Note that the information presented is